BlackRock had a great report on Friday night. The ETF share of total trading volume in the month from February 24th to March 23rd, it was 27%. At the end of February, it went to 37% last week. So think about this, Nick. Nearly $40 of every $100 traded in the U.S. stock market is now done through an ETF, or has been in the last couple of weeks. This is unusually high. Does that have any implications for trading overall, given that most ETFs don't actually trade the underlying stocks? Most just trade between themselves. There's not a lot of creation and redemption much of the time when these ETFs trade.
Yeah, that's right. I mean, I think of it in sort of two frameworks. The first is short-term, where the ETFs basically took a lot of the load of repricing assets and repricing risk without having to go to the underlying asset, as you very rightly point out. And that's a net positive, I think an unalloyed positive. It allowed price discovery of asset classes much faster and more efficiently than going through and figuring out the underlying asset prices and then bubbling up to a top line. So that's good. The longer-term issue, which I think is important for the industry, thinking out 2, 3, 4, 5 years, is these kind of dislocations, these kind of crises tend to only accelerate the move into ETFs further, because whenever you see market volatility, you tend to see declines in asset prices, and it reminds investors that long-term returns have been lower than historical averages. And in that context, you want to have a transparent low-fee option for your capital, and that is the ETF solution in a nutshell. So I think there's a short-term issue where they worked well and helped price discovery, and a longer-term issue that says the ETF industry should look at this event and understand that the AUM is only going to rise further in the next 2, 3, 4, 5 years.
Yeah. Reggie, do you buy into that this will, what we've been seeing, will accelerate the move into ETFs, number one? And number two, Nick brought up a very interesting point, which is what a lot of the ETF haters bring up, which is the ETFs are leading the stock market. It's not the stock market that's leading the ETFs. Is there something wrong with that idea at all, or is there any reason for us to be concerned with that?
Well, I think investors who are not investing in corporate bonds for cap structure, but only for exposure, I think the passive vehicle or ETFs is probably the first route of choice, because going back to LQD, you can pick up an ETF that represents 1,900 different corporate bonds and have a exposure across the spectrum. And so for that perspective, just like you saw in SPDR, when it was first launched in the U.S. in 1993, you see folks navigating towards the major mixed benchmarks in order to hedge their exposure. So yes, I do believe over the course of time that the ETFs will be the vehicle of choice for exposure and the hedging vehicle. As far as the naysayers, I think anytime you have a fair market where you have arbitrages and market makers like GTS is buying and selling an asset and then pricing real time the marketplace, the markets are fair and transparent and liquid. And so I don't understand the argument against having more transparency and yet more pricing and more capital, because it brings nothing more than efficiency in the marketplace. So efficiency is where I think investors will win in the long term.
Yeah. I want to bring up one other ETF tied to the bond market that I got a lot of questions on, and that's a VanEck Fallen Angel High Yield ETF. The symbol here is ANGL. They track a market cap-weighted index of bonds that were rated investment grade but are now rated junk. Now, this is, of course, the highest quality junk, but it was investment grade. That's why it's called a fallen angel. And essentially what you are betting here, gentlemen, it seems to me that they're buying bonds that have downgraded to junk, so they're cheaper. So you're buying them when they're lower priced, theoretically, and the hope seems to be here that you're going to be able to eventually, they'll either move up in price because they'll stabilize, or they'll go back into investment grade, and it's sort of a buy low, sell high ideology. This is sort of like the highest quality junk concept. Reggie, I wonder if you could talk about these investment downgrades, these rating downgrades that are coming, and whether that's an interesting philosophy for getting into high yield in a sort of high quality way. People have been asking me a lot about this Fallen Angels ETF, so I wonder what your thoughts might be on this.
Well, I think, one, it's also a search for yield, and just like Investor's Choice with the junk bond ETFs. There's been nothing but a hunt for yield across the spectrum. So, a falling angel ETF, where Van Eck brings it out, I think it's more of a bet around fundamental value and relative value with this ETF here. And so liquidity is here, I think, from the perspective of our investors looking at it. Absolutely. Why? Because it's a higher yielding product. And then, and as you state, there's opportunity for them to go back to investment grade.
Yeah. And Nick, just to end with you, Reggie's right. The investor interest in high yield has been enormous. CNBC viewers love high yield funds in general. But as we see here, they can act a lot like stock funds. They are essentially plays on credit, not plays on interest rate. And when you've got credit concerns like we've seen with companies maybe not being able to make all of the debt obligations, these things can go down fairly quickly. What is your data revealed about buying into high yield funds and the right and wrong time to get involved in them?
Yeah, your existential point is correct. They act a lot like stock funds, so you're going to have a high correlation, and that data shows that clearly, between equity funds and high yield funds. So you're getting basically a yield pickup with a equity-like near-term risk profile. It's important to understand, though, that the Fed chose the investment-grade market to backstop and not the high-yield market. And so for investors looking for some yield but wanting that bigger backstop, then the investment-grade side is the way to go. And it's important to understand the Fed did that for a reason. 25% of LQD is financials. It's banks. You know, the big banks are 14% of LQD. So the Fed had to backstop that. And in the Fed stress tests, the BBB market is part of the framework. The high yield market is not. So it's a riskier perspective in terms of a final Fed backstop as well.
Yeah. Yeah, that's a great point, Nick. It is buying LQD was partly a Fed's way of helping to backstop the banks, certainly the debt of the banks. I think that's a very good point.